Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Silicon Valley. Welcome to the show, my good friend, Neal Bawa.
Well, thanks for having me back on the show. It's been a while. It's been more than a year, so great to catch up.
Great to have you here, Neal. Now, you're active in multiple different asset classes, some development, and love to get your perspective on some of what I'm seeing in the market. Let's see if you're seeing the same things. But maybe before we dive into the details, perhaps give a little bit of your backstory and how you got to this point in your journey.
Sure. Recovering technologist, ran a tech company for 15 years, got into real estate because, I live in California, big fat tech salary, wanted, tax sheltering, did that for about 10 years on my own money. Sold my company in 2013, had a big taxable event, jumped into real estate with both feet as a general partner. So 1,300 investors now, 350 million of their equity is deployed into 25 projects.
Love it. So we're in a weird spot in the market. We're definitely in the middle of a market cycle. We've seen some spectacular failures. I'm thinking of more than a couple, including one in the last week or 10 days. And so we're in a market space right now where there's clearly some distress. A lot of the family offices that I'm speaking with are using this word opportunistic in a sentence, and that's usually code for buying distress. Are normal deals getting done today? What are you seeing? What are you seeing in the market?
So, the best reference is to look at, the incoming reports from Yardi and CoStar and Berkadia. So, I look at CoStar most often. From what I can see, the normal kind of deals are down somewhere around 70% in volume. And I don't want to use the 2022 maximum benchmark. I mean, from a regular year's volume, we're down maybe 60+%. And I think that's simply because people who don't need to sell are absolutely not going to sell, right? So, and people who need to sell, a lot of them are still holding on, hoping for a better tomorrow. And they're just trying to figure out how to fund the next 12 months. But nobody's really thinking of selling if they have absolutely no choice. Obviously, there are some properties that are being taken back by the bank. And what happens in our world is we think of the world as being the syndication world. But I did some calculations 3 years ago, Victor, that the syndication portion of multifamily is about 4% of the US multifamily market. 4%. And we don't think of that number because that 4% generates 50% of the noise, right? It's just like social media, right? We're the noisiest portion of that bunch, but we're only 4% of multifamily because a lot of the other 96% is either institutional long-term holds, or there are people that are basically doctors that have been holding on for the last 10 years. So they have so much equity in these properties that today's conditions really do not matter to them. All that's happened is their rents have dropped by 5%, but they were already up 50% from whenever they bought them. So it's irrelevant. So I don't see distress in the multifamily industry. I see a lot of distress in the syndication portion of the multifamily industry because that's the portion where there were a huge number of purchases in 21, 22. All of them were bridge. And a lot of those people simply don't have the ability to continue to fund the bleed. Whereas, rich people that have bought a property are probably still funding that bleed if there is bleed. So a portion of the industry has substantial distress and the rest is fine. And the rest, that bigger portion, that 96%, they're just not transacting right now because they don't need to. When we see properties, it's fair to say that the number of properties that are going back to the bank are up 4 to 5x. But when we look at that in perspective of the entire multifamily industry, I think the total, beyond 60 days delinquency rate is about 6%. Office is at 14%. So obviously, not comparable. That 6% is up from, I think at its lowest, it was like 1.5%. So it's obviously significantly up from that level, but you wouldn't call it a distress market until you really hit 10%. Now, could it hit 10%? Maybe, but I don't think it goes that far for a wide variety of reasons.
I'm going to quote some Houston numbers just because I have them top of mind, but we're seeing the same thing in other markets. So in Q1, there were about 6,250 completions in Q1, and there were approximately 3,500 absorbed. Now, if we break that down further, vast majority of those were Class A. Over 3,000 were Class A. There were about 500 absorbed in Class C, and then negative 750 in Class B. So a lot of Class B is getting squeezed from both above and below.
Yeah.
Because if you're in a Class B apartment today and for an extra $25 a month with a leasing incentive, you can be in a brand new place with modern amenities and all the rest, a lot of people will move, even if it's just for a year. So that's clearly a factor. How do you see that playing out? I mean, some of the failures that we've seen have been in that B and C class product, those value add projects that work beautifully in Excel. They just didn't work beautifully on paper or in real life.
Especially when there's a lot of new supply, right? The new supply is really to blame for this because people will not live in a B when they can live in an A and actually pay the same amount, as you said, for a year. What's interesting is in the last 12 months, Class A has actually done fairly well. Its occupancy has gone up. Part of it is because there's less supply coming on board, so a lot of the supply is getting leased up. B and C's are suffering more now as the A occupancy goes up and their concessions stay high. I expect to see continued failures in markets such as Houston, Austin, San Antonio, Phoenix, and maybe another 5 or 6 markets in the US. And again, I want to point this out. 337 million people. The distressed markets are about 50 million people. So once again, that's about 15% of the United States that where the markets are, distressed enough for there to be a significant number of failures. There's always failures in multifamily. In any given year, stabilized year, there'll be failures. But obviously these failures are up. So I expect to see B's and C's fail. I also expect to see A's fail. And I think the failure of the A's is what's happening is it's now so expensive to lease up the property that you need to put a huge amount of pref equity in, or you need to raise a huge amount of equity, some pref equity. And some of these people don't have the ability to raise it. Some of them do raise the pref equity, but then that pref equity then puts an incredible amount of pressure on the property, and they eventually end up having to sell it. So I think that the answer to your question, you asked me about B's and C's, that the truth is in markets like Houston, especially the 3 big markets in Texas, Dallas is not as bad as the other 2, but as the other 3. But I expect to continue to see for the next 18 months, A's, B's, and C's fail, mostly in the syndication industry. But I think that there's going to be some that will fail outside of the syndication industry as well.
If I look at some of the failures that I've casually looked at over the last little bit, oftentimes it was because, frankly, the investment thesis was, in my view, flawed. They were thinking, there's so much demand, I'm going to go outside of the normal area. Maybe I'm going to go into a historically distressed area of the downtown and build a brand spanking new apartment complex. But really, they're in a social desert. It's just not a walkable part of the community. We've seen it in New Jersey in areas that were, they're close to Manhattan, but you've got to drive through an industrial wasteland to get to your property, and it's not a walk to the grocery store. So those properties are also struggling because, again, of location, even though, it's in the radius, it's in the New York area, or it's in downtown Houston, or it's in downtown, fill in the blank, but they picked the wrong location. And that's less to do with supply and demand, more to do with the entire process of just picking the right location.
Yes, but I agree and I disagree, right? So I think the vast majority of the properties going back to the bank, maybe 60, 70%, are exactly that description. But I think that there's properties that have done nothing wrong. What has happened is those particular markets, the cap rates have decompressed more. And that has basically dropped the property value to the point where it cannot be refinanced. And if it cannot be refinanced, you basically, unless your bank is friendly and keeps giving you extensions, then it has to go back to the bank. And recently, banks have become more aggressive. I felt like 2024 and 2025 were extend and pretend for the banks. But in 2026, things are catching up with the banks because the Federal Reserve has these harsh restrictions with the banks to declare non-performing or NP assets. And now they're saying, we just want it back. We need to get rid of this. We need to get it off of our books. We can't keep this many non-performing assets on. So I think in some cases, the extend and pretend cycle has stopped working because it has taken so long and cap rates have not compressed again. But there are properties that I know of. One of my properties is like that. I mean, this property has been at over 95% occupancy for 2 straight years. Before that, we had some challenges because there was inventory. So average occupancy over 95%, average delinquency 2%. I am either first or second in the market for every possible metric, rent per square foot, brand, call it reviews, in every possible way. My bank, is very complimentary. But the bottom line is the interest rate for that property is so high and the cap rates in that particular market have basically decompressed by 150 basis points. So I can't refinance, I can't get rid of it. And the rate is so high that I keep bleeding. So I keep paying the bleed $20,000 a month and finding ways to deal with it. But it's not endless, right? But if you looked at the property for the last 2 years, geez, I can't think of one step that property has put wrong.
Yeah, and that really speaks to more of a structural issue than anything that's intrinsic with the property.
Yeah, so there's the bigger bucket is still the properties that you mentioned. The smaller bucket is good property. Basically can't refinance. Do not have the ability to refinance because the property's values dropped by 25%. Right? If they drop by 15%, you have options. If it drops by 25%, you just hold on as long as you can.
Yeah, absolutely. So back to the original question, are normal deals getting done? And yes, you said they're down by quite a bit. If so, where are they getting done?
I mean, so firstly, one of the key things is, once again, we tend to focus on our bubble, right? So, I talked about the syndication industry being very small, but you realize that the vast majority of the country does not have any sort of distress. Rents are actually going up. So I just saw today, just right before I got on, Yardi said rents rose 1% by 1% in the first 6 months of the year. So 2% run rate. And most of that rise is outside of the sunbelt, where the syndication industry, 80 to 90% was really in the sunbelt and portions of the sunbelt, right? We're not in every market in the sunbelt. Deals are getting done in markets, that are Rust Belt markets that are doing really well. For example, Kansas City has 3% rent growth. Indianapolis is at 2% rent growth. And Omaha is at 3.5% rent growth. So there's all these markets that are doing fine. Then there's markets, ironically, in California, where I live, that are doing really well because of AI. Like San Francisco rents are up 15% year over year. So obviously, those people can sell their properties. They don't have a problem with selling them. And they're actually getting a great deal because they're selling at sub-cap, 4-cap rates with 15% rent growth. So they're making huge amounts of money. New York has recovered as a market. I mean, New York was really badly hit with COVID, and now that market's recovered. So obviously, that's a market that can transact. They're still sub-5 cap. Boston. So there's a bunch of markets outside of the Sunbelt that are doing okay enough to transact. It's not a great time to sell, but they're not right now. If somebody wants to sell in those markets, they can sell.
I love it. Well, Neal, love the conversation as always. If folks want to connect, if they want to learn more, what's the best way?
So we do 8 webinars a year. 4 are about AI and its impact, and 4 are about multifamily every year. About 10,000 people watch these webinars. They're at multifamilyu.com/club. That's multifamily followed by the letter u.com/club. No subscription, no upsell, no education, package that we sell to people. Just people get together and they discuss it. 1% of them become our investors. 99% get, education for free.
Love it. Well, Neal, great to connect as always. And for the listeners at home, definitely want to connect with Neal Bawa at multifamilyu.com/club. Link will be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. And we'll talk to you again tomorrow.